The information presented is for informational purposes only. The opinions expressed are not necessarily the opinions of any Daikin company. This information should not be confused for accounting, legal, medical, or other professional advice. Please seek advice from a qualified professional for any specific questions.
Welcome to the Accelerated HVAC Success. My name is Ben Middleton. I'm the National Sales Training Manager for the Goodman, Amana, and Daikin brands. Today, I'm joined with Eric Howarth. He is the VP of Home Innovation over at Goodleap. Eric, thank you so much for joining us.
Hey, man. Good to be here.
So, Eric, you and I were talking just before we got on this a little bit about the state of finance and what's happening in the HVAC industry specifically. And, there's all kinds of news that we're hearing every single day about interest rates. In fact, I think the Fed's even meeting today and deciding what they're going to do. What would you say the state of finance is right now for the HVAC industry?
I'd say the state of finance for home improvement lending period is kind of a mess. It's kind of all over the board. I think it's historically kind of unprecedented right now. You had the Fed raise rates at kind of a record pace that put banks off balance. You had people sitting with lower than market interest rates that they couldn't sell in the marketplace. And when you're stuck with a ton of assets that you can't sell in the marketplace in a business where that's what you do, it makes it a little tough to keep going. So you've got unprecedented. You just can read the news. I mean, there's banks that have gone under. Mm-hmm. There's finance companies in real trouble. Finance companies that have had to be sold or acquired for a lot less than what they were bought for, billions of dollars less than what they were bought for. It's one of those historic things that we've seen a few times. I saw in 08, 09, and we're seeing again. So it's capital markets is probably one of the toughest it's been since 09.
So it's interesting, and usually when we think about home improvement and we think about the HVAC industry, we don't think about banks, and I don't think a whole lot of people have a whole lot of sympathy for what's going on with the banks, typically from the contracting side of the world. But we do know that for homeowners, the pocketbooks have gotten tighter too. We were also talking a little bit about just the state of the consumer credit cards and what's happening there. Can you tell us a little bit about, just what's happening with consumer credit cards?
Yeah, I mean, I know I read a bunch of things this weekend where credit cards are at record defaults. You've got a record amount of debt in the country right now for people holding those credit cards. And you've got inflation on top of it. And I think what you're starting to see is a lot of people squished. You're seeing default rates go up for consumers. And many of our contractors out there in the marketplace have seen, contraction from finance companies as a result. They're tightening their guidelines and they're tightening their approval rates to try to fit and make sure that they don't get stuck with a bunch of loss. Because I think what a lot of people don't understand about banks is banks, when times are good, times are great, but there's a reason they have to put money away for a rainy day, because when it's bad, it's bad. So it's, and I think historically, if you look over time, that's the way it's always been. Banks in a heyday can make a lot of money, but it's important that they put that money away, which is, why the feds came in and set up all the rules for having certain amounts of money in banks and stuff for these rainy days when stuff like this happens. So I think there's sort of a misnomer that banks just make too much money. In the good times they do, but they have to put it away for the bad, because when the bad comes, it doesn't take long for a lot of loss rates to go the way the system's set up.
So you've got a lot of consumers that may have a really attractive interest rate that they got a couple years ago, and they're sitting in their home right now. And maybe they were thinking they were going to move, but a lot of people are second guessing that at this particular point in time, saying, with the rate I've got, I can't get a comparable home, or much less a better, upgrade the home to what we've got. and keep the payments the same. And so, with that situation, do you see more of a trend towards home improvement overall, or what are you seeing as far as consumer trends in the home improvement space?
I think it might change that way over time. I think you're seeing a lessening in demand overall because a lot of people pushed it forward during COVID. You've even seen Home Depot come out and give their stats. I mean, anybody who's read about it can Google it. They showed projections down, and I think we're going into a tough time, and I think what most people don't realize is how important financing is during that time. And I think that's why it's always the 80-20 rule with contractors, why 20% of them are so successful and the others scratch their head trying to figure out what's going on. It's financing's a part of that marketing and that ability to make that extra margin because you're selling the extra high margin doohickeys that make things go. And if you're not selling those high margin doohickeys, you don't have that extra money to put into marketing. So it's when the economy starts to go down, I think the first thing that middle and smaller guys do is pull back on marketing and don't realize that there are consumers out there that have cash and they have to take full advantage of those folks because they still have the money for those goods.
So let's talk and pause and talk a little bit about the successful contractors, the bigger contractors that you work with that are out there. What are they doing right now in terms of financing to ensure their success and make sure that their people are busy and they can continue to grow or maintain the business that they have?
I think everybody's just kind of starting to change their philosophy and take advantage as much as they can of each individual sale. I think there's a tendency when times are good to not really take advantage of every sale as a salesperson and everything else, knowing you've got 5 other calls coming up. But if you went from 5 calls a day to 2, you're probably taking advantage of those 2 calls a day a little bit more. And I think what we're seeing is we're seeing more of a propensity to work towards, selling more while you're in the home. Even a lot of larger contractors looking at selling multiple items and getting into other types of home improvements, add-ons and things like that can add to the marketplace. But I think overall, what you see at first in times like this, having been through it twice in all my years of doing this, I think what you'll see is you'll see the middle and smaller guys pull back on marketing, unfortunately. They stop marketing. The bigger guys continue to market. They pick up some market share for a shorter period of time because people have started to pull back. And then you see everybody start to kind of slow down. And then you see who's really made of what when that happens, right? You see who can pivot and make things happen. But I think it's tough. I've talked to a number of large contractors out there that, people are starting to see the slowdown for sure, and people just not pulling the trigger on replacements.
So when you look at the larger contractors that are out there, do you see them jumping from one bank to another bank often, or do you see them forming a deeper partnership with the bank and trying to, and what levers do they pull, if any, to be able to leverage that relationship for mutual benefit?
Yeah, I see it all over the board. I think the one area that I found over all my years of doing this that contractors miss in the sales process is they kind of look at financing as esoteric or something that's hard to understand when it really isn't. It's a pretty simple math. But what they get wrong in the math a lot of the times is they don't look at the full equation. A lot of times, especially when times are good and everybody's buying similar to each other and things are good, they don't really look at what approval rates mean to them. They don't look at the difference between interest rate, term, dealer fees, and the buy rate of that company. And they don't look at it down to the level of, are they getting partial approvals? Partial approvals How many of those partial approvals are actually turning into a repair? How many of those partial approvals don't turn into anything? You find that a lot of them don't track. They only track either the wins in the approvals or anything that just was a repair, but they don't track was financing responsible for making that happen. They oftentimes don't track whether it's a risk-based pricing model. If they're getting if they're offered a $999 upfront, no cost, and that's only happening 30% of the time, and the rest of the time it's countered with a $13.9, then it's probably not a $9.9 no cost.
Right.
But that's the tricks the finance company's done over time to kind of get contractors to look at a rate sheet, because they realize they just don't take the time to look past the rate sheet. So I always tell our large contractors, vet me, right? And they should vet any finance company the same way. They should look at what the approval rates are based on their net margin. What do they bring home from the finance company? And if they're bringing home more deals, is that the difference between what the dealer fees are and any, for the larger guys, some of those guys are even getting money back per transactions. So when you add up the money back per transactions and you add up the difference in dealer fees, are you making more if you're closing more deals? So that's the way you really should look at financing, because ultimately it doesn't really matter if you never closed a deal. It's sort of the if a tree falls in the woods kind of thing, right? So I think a lot of times finance companies are shoved all the way down to a rate sheet and figured that they're all the same. And in my experience, that's not the case. As someone who used to vet finance companies, who did it for Daikin at one time, it's not the case. I mean, they really need to look at the customer service. Are they taken care of? Are their customers taken care of? I mean, there's been a number of cases that you can just look at and Google online where actual homeowners aren't taken care of, and complaints and everything else. Are they holding, if you're a good contractor, or is your finance company holding the bad contractors accountable and making sure they're not on the platform? There's a lot of things that go into running a finance company. A lot of people don't understand. But I think, to your point, a lot of times they'll come back and say, well, it's your job to approve the loan. So if I'm, in a lot of cases, companies don't understand when finance companies push back and say, we can't take your second looks. It looks like you're just giving us lower FICO scores. Well, the whole idea is, just like in any investment, you have to take the high FICO scores with the low FICO scores. And if you don't have the high ones that pay no matter what, if you don't have those 800 FICO scores that care about their credit so much that they pay no matter what, then you can't buy the sub 700s. And because what happens is it throws off your mix. And finance companies need a mix of the high and the low. As everything in life, the folks that are doing the right thing always pay for the people that aren't. It just is what it is. It's in everything that you buy and everything that you do. When you buy a big screen TV and get a 12-month same as cash, that's a risk portfolio over the whole group of folks that are going to apply for that. It's just the way it works. And I think a lot of times there's a tendency to just look at a rate sheet and say, well, you're approving it. Well, but that's not a good partnership. And I think what you really need, if you're going to have a good partnership with a finance company, just like any partnership, like your marriage, like anything else, there has to be honesty and there has to be transparency and there has to be a discussion about what's right for each other. And so, I personally try to have that honest conversation with the contractors and say, I need those. I'm sorry. I mean, I'd love to continue to do business with you and get your second looks, but that doesn't work for me, because eventually it doesn't work for our investors. It's the people that invest in our company that are expecting a return. And if I have higher than market defaults, then that's not going to give them the returns that they're expecting for the dollars.
Well, let's talk a little bit more about approval rates then. You look at that and everybody knows what their own personal score is, and very often we have no idea what the customer score is. You and I have both been in the $1 million homes where the scores in the maybe sub 600s, and then you've been in the little shack in the woods where they have a perfect 800 score, and you just can't tell based on looking around a space. But do you see people's credit scores going down in the current economic times that we're in? Do you see approval rates going up? How are those trends on both sides trending?
Yeah, we definitely see FICO scores going down as debt goes up, right? Because it's a calculation. You'll see FICO scores can go down. So, and I think you'll see it mostly in the lower stratas rather than the higher. I mean, like I said, the 800 FICO score folks, they fight to keep their FICO scores at 800. They'll do it. It matters to them. But when you get into the low 700s and the 600s, you start finding folks that are a little more lenient around stuff like that. It's not as important to them, and some of those folks are laden with debt, like we talked about earlier in this conversation. And as debt goes up, it's a calculation. If your debt goes up on your credit card, your credit score is going to go down. And so you'll find that there's a lot of folks. You'll find that as inflation goes up, more and more people, we just talked about, we're missing payments on their credit cards. As they miss payments, you're going to have a lower credit score, and you're going to have a less likely chance of getting approved through the finance company. So I think understanding your approval rate and matching that against whatever your dealer fees and your full pull through rate is. Did I get a partial approval? Did that result in a sale that it shouldn't have been? So instead of getting $15,500 as equipment's gone up in cost, average sale used to be $9,700. Now it's $15,000. Did I just get an approval for $4,000 or $5,000? Did that do me any good? And I think where a lot of installers fall down is they just don't really look at that particular model. They know, hey, well, I got approved or denied. Well, a finance company might give you a partial approval, and they're going to call that an approval. But did that partial approval really turn into a sale for the full amount? Did it turn into a repair? Did it turn into a no sale? And I think when you get into those types of scenarios is where, the KPIs aren't put in place to actually track those things.
So, back when I was on the contracting side of the business, we used to always have the joke around the office that we don't take cash, and if we do on this rare occasion take cash, we need 3 forms of ID and their firstborn child. Basically saying it was easier for us to just offer financing 100% of the time.
Sure.
I think what you've been talking about as far as being a good partner is that's really going to improve the mix. Even if that consumer didn't need the financing, when you offer financing every single time, you are going to see higher dollar amounts on the tickets because the person's not taking money out of their checking account. You're going to see a higher closing percentage, and you're going to be providing that higher mix of credit scores back to the financial institution. If more contractors do that, I would imagine you're just going to see an overall higher approval rate just by making sure they offer financing every single time.
Well, yeah, because if you don't offer financing every single time, then you're waiting for customers to ask.
Right.
And usually those people are desperate and they're asking, right? So it's just like, I always tell people, what's your experience when you walk into a car dealership? Have you bought a car recently? Do they give you a choice but to sit at the table and talk about what you can afford monthly? And the whole idea is that it's methodical, that you're not prejudging a customer based on what their house is like or anything else. Because you never know. I mean, you could walk into the house, just like you pointed out. They're strapped on cash. Their business is, at a bumpy stage. They've maxed out their credit cards, and they're running a 690 or a 680 FICO with too much debt, right? Because debt to income's something that finance companies look at. If your debt to income's off, and if every contractor has stories for me all the time about that 700 or 800 FICO score that didn't get approved,
Right.
that's debt to income usually. They have a lot of debt showing on their thing without, per their job, what their income is, right? So when they model that, when the finance companies do, they have what they call modeled income. And when they put across that modeled income, if it doesn't come out, then they're most likely not approved.
Sure.
So I think, when you look at the full package of a finance company, I think one of the more important things that you have to look at right now is, are they going to approve through this? I mean, anybody who lived through 08, 09 and what happened then, we had the biggest players at the time, GE Capital and other things, and Wells Fargo and a number of others, they were buying anywhere from, around anywhere from 35 to 25% of everything they went through. So people went from 70+% approval rates to 25 to 35%. So, and it was just what was, willing with the times to do. So you have to watch your approval rate, make sure that you're a good partner, and stay in good contact with your finance company and have discussions about, what's going on in the market and what they need to do, and realize that to be a good partner, no finance company can take that. And if anybody has to just Google what's going on in the financing industry, finance companies going out of business or in jeopardy, or how much money some have lost. I mean, we have large finance companies that have lost like billions of dollars over the last few years, and a lot of them bet on the come. They just bet on that interest rates wouldn't stay high too
Right.
long, and so they kept taking lower interest rates or lower dealer fees, and until it got them in trouble. And it just like any business, there's a little risk involved, right? And it's just what you're willing to do with that risk, we talked about what the state of the finance company. It's a little bit of turmoil, and I think the misnomer is that it's good when other finance companies go bad. Maybe in HVAC it might be good when your competition goes under, but in financing, we all are working with the same collective group of investors. So it's never good when things go bad in the financing world. I'd rather go toe to toe with somebody and beat them head on and everybody be in the same state than be in a situation where we have finance companies that are because it just spooks investors. And we don't want to spook investors. We want to be good stewards with their money, just like any of the finance companies any of the HVAC companies we have out there that have investors of their own. I mean, they don't want to spook their investors, and they don't want to put their investors in a bad place, or there's consequences. So
what would you say to a contractor that maybe in the past has been turned down or has been shut off from a financing company? What advice would you give them, or somebody that is maybe newer in business and has never really got into a relationship with a financing company, and they're listening to this and they're saying, okay, I understand that this is important. What kind of words of wisdom or advice would you give them?
Well, to get turned off, you usually have to do a lot. I mean, to get turned off from a finance company, you usually have to not be following up with your customers, because there's an implied contract between you and the installer and the consumer. And what most contractors don't realize, that the finance company has some culpability on what the contractor doesn't do. So once they're in contract with us too, if the contractor does not perform the act that they were supposed to perform, then we're on the hook to figure out how we're going to make that customer whole. And I think there's a misnomer in the industry that finance companies just don't have any culpability. So a lot of finance company or a lot of contractors don't really understand why I have to be vetted. You're approving my customers. Well, we're not just approving your customers. There's a few things we have to do. We have to make sure that you're not, the Russian mob laundering money, right? We have to make sure that we're working with someone in good faith that's not going to hurt customers, and then we're making sure that we're not going to be stuck with a bunch of, once again, protecting our investors, or making sure that our investors aren't going to get stuck with a bunch of bad debt because a contractor didn't fulfill their requirements. And those mistakes can be big in the financing industry. I mean, if you look at especially larger companies when watching those, and if you see, we all know the home improvement industry is riddled with folks that have tried to grow too big, too fast, and got too big for their britches and gone out of business. That's hurt finance companies over time. Remember, they're stuck with all that paper and got to figure out how they're going to get those customers whole. How are they going to take care of those customers and make sure that that's fulfilled? It's just another risk that finance companies take. So I would say this: if in working with your own company, there's only one way to really get kicked off, and that's to give second looks all the time. So you're giving lower than market FICOs to just one finance company. And then number two is to commit fraud. So as long as you don't do those, you probably don't have much of a chance. You have to install what you say you're going to install on your contract. And if you do, then you don't have to worry. As far as getting vetted for the first time with a finance company, ask them what their requirements are. Ask them what their requirements are. And some of those requirements could be as simple as getting on the BBB, making sure you have a score. And I know it sucks, you got to pay for it and everything else, but it could help. Making sure you actually get Google reviews and you have a real website. You don't have a Facebook page. So if your Facebook page is probably not going to count as reviews, in what's going on. So making sure that you do have an actual website, and then making sure that you've got a certain amount of time in business. Obviously, if you just started, you're risky. Most businesses in the first 5 years go out of business. So a lot of finance companies look up to 5 years. If you're less than that, you just have to have a good all-around story to tell. I've been successful I was a general manager of a large company and I started my own. I've been successful at this. So see if there's mitigating circumstances to get involved, that you can get involved. And then some of them might be a couple hoops you have to go through, but ultimately there are also finance companies out there that you don't have to have requirements for because of the type of loan is between them and the homeowner. So you could start there and then work your way up too. Sometimes those are a little inconvenient in the sense that the homeowner gets funded and then you have to get funded after, but it's a place to start.
So you're saying a lot of times, even if you ask the criteria, maybe they say, hey, yeah, you need to be in business for a year or two. If you have the right story, it's probably worth exploring and seeing if you can get approved.
I think it is. I mean, I did it for a living and got contractors through. I mean, if it's a good story and it makes sense. I mean, obviously somebody who ran a large PE group for a long time and decided they were going to start their own, they have the experience to do it. And so that might be, a good risk for the bank to take for their investors or their bank account holders or whatever else, and they're willing to do it. But those are rarer, but they can happen. I would just say do all the basics, get some installs under your belt, make sure that you have a website, make sure that you have Google reviews in place, make sure they can find who you are. It's surprising to me how many contractors that have been in business for 10 or 15 years that have a Facebook page, and then they took over from their dad. Their licensing never got changed. It's not up to date. It still says the dad's name. And the finance company catches that it's not a junior, but it was seniors, and they're like, hey, this never got changed over. There's. Just make sure your ducks are in a row before you do it, but ask the requirements. They should be able to tell you what the underwriting requirements are to get involved with the finance company. And then if there are mitigating circumstances, make sure you let them know.
Let's talk about interest rates a little bit. So I think a lot of contractors may get hung up when they start to talk about interest rates. And the stories we've all heard, well, I would never finance a system. A lot of contractors say that if I put it in my own home, so why would anybody else? What they don't think about is the fact that they probably wouldn't even pay for the labor to have it put in, and they probably ask the distributor or manufacturer to give them a break on the equipment itself. But also the, it's just tough talking about finances with people. And so when they see some of these 13, 14% interest rates, what are the typical interest rates for credit cards today? And how does that apply to the unsecured loans that people are getting for home improvement?
Credit card rates are going up. Anybody who's applied for a card recently, I mean, they're at 29% or so. They might have specials that run you in before, but I haven't seen any lower than market credit cards. There's no the 7.9 or the 9.9s going right now or anything like that. They're all the higher interest credit cards. Because of course, as debt goes up and people stop to pay, the banks have to make money to recoup that. It's just like in any business. But I think the hang up on interest rate is getting easier as mortgage rates are hovering around 8.25%, been as high as 8.5. At first, it was a little tough. As interest rates spiked, it's like everybody scratched their head going, what's going on? I don't understand. They don't understand what the Fed fund rate is, right? They don't understand how banks sell to each other at the Fed fund rate. They don't understand how the 5 and 10-year Treasury affects. They don't understand any of that. So all they saw is certain companies keep their rates low and certain other companies go up, knowing some companies said, hey, rates aren't going to go down in any foreseeable. Some said, nah, the Fed won't let this happen, and they bet. So I think people are becoming sensitized now and desensitized to the fact that interest rates are high. So at first it was a little shocking. I think it was a sensitive subject. You know, people are like, "Oh gosh, why would I do that?" Or "I would never offer that." And now people are like, "Oh, well, that's a fair interest rate." You know, and I think. There was a time when mortgage rates, were 19%, so, I think it's all relative to the times that we're in. And I think people are getting more, used to it, but it's still tough for folks. Like you mentioned earlier, if you're sitting on a 2.66% mortgage, you're probably not going anywhere. And there's a good chance through COVID, you did a lot of the stuff to your house already. So if your HVAC does go down, I think the thing is if you're in the home, then what can you do for that folks?
Right.
If they're going to be in the home, then it's selling them. You're going to be in the home for a while. Here's all these IAQ devices that we can put on that make your life better and more comfortable. Here's these other things we can do, because you're going to want to get as much margin out of each individual customer. And when you vet your finance company, you're going to want to make sure that your approvals can house that type of upsell. And if your average approval rate is going to be under what you're offering, then it's no good to you.
Right.
So
I think you and I have talked in the past. There's almost this magic number that you try to get the monthly payment to be around. Where are you seeing that trend right now? If a contractor can kind of structure their program to get into this area, where do you see that kind of that magic number
Yeah,
hitting?
the magic number used to be around $100 a month.
Right.
When interest rates are down, you're probably closer to $150 to $160 a month. I mean, I think that's the magic number for most contractors. And then if you have ways of showing exercise energy savings or anything else on top of that, you could probably go to 200 and, show them a way that they could save in the long haul based on, electrifying their house or doing anything else. But I mean, I think probably $150, $160 a month is typical.
So by leveraging any buy down rates that you can, rebates that you can get through the manufacturers, and taking advantage of those, you can go ahead and look at what you need to sell that for, and then look at what the appropriate plans are. In fact, a good practice that I think a lot of guys do is they kind of tier the options that they offer. And they say, okay, for the base efficiency, that federal minimum system that we're going to put in for you, maybe they do something that's going to have no dealer fee, or maybe a very small dealer fee. And then they can raise that dealer fee and make more and more attractive plans as they go up, because now they've got support from the manufacturer helping them to offer those better plans.
Yeah, it's I think the shocking thing in the industry to me has always been is that everybody talks about how much high SEER they sell and how much they do, but then when you look at the actual numbers, it's never there, right?
Yeah.
And the actual amount of people that take advantage of those rebates is so low compared to what it could be. And I would just encourage everybody in this time, take advantage of every sale when you're in the house
Right.
and do the right thing for the customer and put them in the best system you can put them in. If they're going to finance it, make sure they put that UV light in and that filtering device and everything else, so that they're going to be in their house for a while at 2.66%. They might as well be comfortable in there, right? And your job's to sell. I think the great thing about contractors and the wrong thing is exactly what you said about contractors in business. I think they make their own assumptions and their own preconceived notions and they put them on a customer. I wouldn't do that, or that's ridiculous. I would never, we don't need that in my territory. But I'll just use myself an example. I moved to Texas about 4 years ago, and I had two 16-SEER decent systems that were 5 years old. Both of the coils went out on them at two different times. But the one thing I noticed is in my pantry, all of my cans that I moved when I moved here, they all were rusting. Right? So I started saying, well, why are my cans rusting in my pantry? And then I just felt like the house was like damp all the time compared to where I lived before. So, I talked to a bunch of buddies of mine and said, what I needed. And I literally invited a contractor out that was a local contractor. I like to support the local ones. I had them come out and I said, hey, what's going on? And they tried to sell me the base system again. And I'm like, well, no, I was told that if I get this inverter system that's a 20 SEER, it'll pull a lot of the moisture out of my house. And I really want my humidity. My cans are rusting. He's like, yeah, you don't do that. You don't need that. So I think once again, it's the preconceived notions on what your customer wants. That there are things that are important to them. My wife didn't like our cans rusting.
Right.
That was important to her. Right. So how do we get the humidity out of and contractors just go right by that and they go right to whatever. When times get rough, it's really a time to look back at your sales process, start reevaluating your sales process, and realize that if 16 SEER, 2-stage plus is a very small part of your portfolio, maybe it's time that it was a bigger part of your portfolio, because that extra couple grand, $2,000 to $4,000 per transaction is going to add up over the year.
Thank you so much, Eric, for joining us. I really appreciate you coming in. And for everybody that's out there, please go ahead and like this episode. Follow us so that you can see all the other episodes that we have coming up on the Accelerated HVAC Success program.
Thanks, man.
Thank you.